Welcome to Griffonomics.
It is great to be here for this one.
Because right now, you are currently staring at the absolute greatest paradox of the AI revolution. I mean, we talk about the cloud and neural networks as if they are, weightless algorithms, like they're just ethereal lines of code floating somewhere above our heads.
Right, like they exist in a vacuum or something.
Exactly. But the reality is entirely physical. The future of artificial intelligence is completely bound by thermodynamics, and quite frankly, it is currently drowning in a demand for water.
Literally drown.
Yeah. And while the financial markets are just completely hypnotized by the silicon, the glowing NVIDIA chips and the advanced AMD processors, what we are doing today is looking past the obvious. We're looking at the physical fluid that is quite literally keeping those incredibly expensive chips from melting down.
Which is a very real threat, by the way.
Oh, totally. So our mission for this deep dive is to analyze a staggering strategic inflection point. We are dissecting Ecolab's transition from a legacy chemical and hygiene supplier into what can really only be described as the mission-critical water utility of AI.
It is a remarkable pivot, and it set the move for the sheer scale of this infrastructure. I've actually updated my digital backdrop. So instead of the usual library shelves, you'll see I'm sitting inside a hyper-modern neon-lit server room.
Oh, I love that. Very fitting.
Right. And the hum you would hear in a room like this, it isn't just data processing. It is the sound of millions of dollars of hardware trying desperately not to catch fire.
Yeah, trying to defy physics, basically.
Exactly. And understand how a company known for, well, sanitizing commercial kitchens is now the absolute linchpin of global AI infrastructure. We are synthesizing a stack of highly revealing sources today.
We've got a lot to get through.
We do. We are pulling from Ecolab's Q1 2026 earnings materials, their internal M&A presentation slides, for a monumental $4.75 billion acquisition of CoolIT Systems, their latest 10K, and some really fascinating transcript excerpts from a recent Baird Industrial Conference featuring their CEO, Christophe Beck.
It's honestly a masterclass in corporate evolution.
It really is.
Okay, let's unpack this, because before we can even begin to understand how Ecolab is going to cool a hyperscale AI data center, we have to understand the foundation of their house.
Right, the core business model.
Exactly. We have to understand how Ecolab actually makes money and sells its services to begin with. You really cannot grasp their future in high tech without understanding how they fundamentally redefine their pricing model in the traditional physical world.
That's a great point, because historically, the chemical industry was basically just a volume game.
Transactional race to the bottom.
Yeah, exactly. You manufacture a massive vat of industrial bleach or water treatment chemicals, and you just sell it by the gallon. The more gallons you sell, the more money you make.
And the customer just views you as an expense on their spreadsheet, right? Like a commodity where they can always just shop around for a cheaper price per gallon.
Precisely. But Ecolab stepped entirely out of that volume game, didn't they?
They absolutely did, and it forms the bedrock of their $16 billion global empire today. They shifted entirely away from selling physical volumes of chemicals and transitioned to an outcome-based pricing model.
Which they call total value delivered, right?
Yes, total value delivered. And this is a profound paradigm shift in industrial B2B sales. I mean, they do not walk into a potential client, say, a global hospitality brand with 4,000 hotel locations, and just hand them a price sheet for laundry detergent.
Right, that would be the old way.
Yeah. Instead, they operate much like a high-end energy auditor. They go in and install digital sensors on the hotel's boilers, the cooling towers, the laundry facilities. They monitor the existing systems, and then they calculate precisely how much water the customer is wasting.
And energy too, I imagine.
Oh, massive amounts of energy. Like, they calculate how much excess energy is being burned because the pipes are scaled up with calcium deposits, and how much labor is lost to inefficient processes. They literally put a hard dollar figure on the total operational value they can create out of thin air for that customer.
I love the energy auditor analogy because it changes the psychology of the sale entirely.
Totally does.
You aren't selling a cost anymore. You are selling a verifiable savings. And looking at the sources, this isn't just, corporate marketing jargon.
No, it's very real math.
Right. It's a very specific mathematical equation. CEO Christophe Beck outlined the exact ratio they aimed for across their contracts, and it is a 7-5-25 split.
Okay, break that down for us.
So when Ecolab walks into an industrial facility and uses their proprietary chemistry and digital sensors to optimize a plant, the customer gets to keep roughly 75% of the total cost savings.
And Ecolab captures the remaining 25%.
Exactly. They capture that 25% as their fee.
That is fascinating. Let's run a hypothetical scenario to make that crystal clear for you listening. So, imagine you are managing a large-scale beverage manufacturing plant. Your water and energy bills are just astronomical.
Which is standard for beverage plants, yeah.
Right. So Ecolab comes in, they install their automated monitoring equipment, they alter the chemical dosing in your water systems, and by the end of the year, they prove, using your own utility data, by the way, that they saved your plant $1 million in operational costs.
So under their model, the plant manager happily writes them a check for $250,000.
Exactly. Why? Because your overall bottom line is still up $750,000. You didn't have to invent any technology. You didn't have to hire chemical engineers. You essentially outsourced your efficiency to Ecolab.
It aligns the incentives perfectly. I mean, Ecolab is highly motivated to optimize your facility to the absolute maximum because the more money they save you, the larger their 25% slice becomes.
Now, if you are listening to this, you might be thinking, well, that sounds great in theory, but how do you actually manage that kind of bespoke, consultative relationship across millions of different customers?
Because a beverage plant needs something very different than a pharmaceutical lab.
Exactly, or a hotel. And this is where the recent structural reorganization comes into play. According to the 10K effective January RIS 2025, they rolled out what they call the One Ecolab approach.
Right, I saw that in the filings.
Yeah, they took this sprawling, complicated enterprise and aggregated their operations into 4 highly focused, reportable segments.
And this realignment was crucial for streamlining how they deliver that 725 value split. Let's walk through those 4 segments quickly.
Yeah, let's hear it.
First, you have the global water segment. This is heavy industry. We are talking paper manufacturing, mining operations, primary metals, and large-scale food and beverage plants. This segment is entirely focused on optimizing immense volumes of industrial water.
Massive scale.
Right. Second, you have global institutional and specialty. This is what most people historically associate with the Ecolab brand. It covers hospitality, healthcare facilities, restaurants, and lodging. It is their legacy core, focusing on hygiene, infection prevention, and commercial cleaning.
Then you have the third segment, which is global pest elimination. And this operates as a fascinating standalone business. They aren't just spraying for bugs, they are protecting pristine commercial environments, like food processing plants and luxury hotels from contamination.
Which ties right back into hygiene and safety.
Exactly. And finally, the fourth segment is global life sciences. This is highly specialized end-to-end contamination control for pharmaceutical manufacturers and personal care brands.
Because if you are manufacturing a vaccine, your clean room environment has to be absolutely flawless.
Flawless. So looking at this 4-pillar structure, the strategy becomes really obvious. They can go to a colossal global customer and cross-sell seamlessly. One unified point of contact offering total value across water, hygiene, and pest control.
Precisely. And this integration creates an incredibly sticky business model. I mean, this is not a transactional relationship. They are deeply embedded in the daily operations of over 3 million locations globally.
3 million! That is just a staggering footprint.
It is, and because they are actively monitoring the systems and continuously generating dashboards showing the facility manager exactly how much money is being saved daily, the customer is constantly reminded of the value.
And this brings me to a critical point. I really want to challenge the way we classify this company, because if you look at over 90% of their revenue, it is recurring.
Right, it behaves exactly like a subscription.
Yes, we see this model everywhere in tech, right? Software as a service. You get a customer onto a platform, you prove the value, and they pay a recurring fee forever. Ecolab is executing that exact same playbook, but in the physical world of chemistry and fluid dynamics.
That is a great way to frame it. A physical world SaaS company.
Exactly. You install the monitoring equipment and the automated dosing pumps, that is, the razor. But the highly engineered proprietary coolants, the specialized water treatment formulas that constantly need to be replenished to keep those systems running at peak efficiency, those are the continuously purchased blades.
So once you install their razor, you're structurally locked into buying their blades.
The structural lock-in is profound. I mean, think about it. If a hospital administrator looks at their budget and says, Ecolab's chemical fees are too high, I'm going to switch to a generic discount supplier.
Which happens all the time in procurement.
Right. But here, the math actively punishes them. The moment they switch, they lose the digital monitoring. They lose the automated optimization.
And then what happens?
Within a month, mineral scale starts building up in their boilers, their energy efficiency plummets, their water consumption spikes, and their overall facility costs absolutely skyrocket. The total value delivered model mathematically proves to the customer that it is quite literally more expensive to fire Ecolab than it is to pay their premium fees.
Wow. And that stickiness, supported by that 90% recurring revenue base, just generates an absolute geyser of predictable, reliable free cash flow.
Here's where it gets really interesting. Because having a geyser of cash flow from cleaning hotel sheets and optimizing brewery water is great, but what do you do with it?
You deploy it.
You take that predictable cash flow and you weaponize it. You use it to buy your way straight into the white-hot center of the artificial intelligence boom.
And this brings us to the strategic inflection point of the entire analysis.
Yes, it does. The internal M&A presentation details a staggering $4.75 billion cash acquisition of a company called CoolIT Systems.
And this is the moment Ecolab pivots from a slow and steady industrial player to a mission-critical tech infrastructure provider. They took their legacy mastery of fluid dynamics and applied it to the most advanced technology on Earth.
Liquid cooling.
Right. CoolIT Systems is a leader in what is known as direct-to-chip liquid cooling. But before we get into the actual plumbing of that, we really need to talk about the financial weight of this deal.
The numbers are huge.
Massive. Ecolab paid $4.75 billion in cash. For context, they paid a multiple of 29 times the next 12 months adjusted EBITDA.
29 times.
29 times. And 24 times the projected 2027 adjusted EBITDA. CoolIT is expected to generate roughly $550 million in sales over the first 12 months post-close.
Okay, hold on. Stop right there. I really need to push back on this because as the listener, I'm looking at those numbers and my alarm bells are ringing so loud right now.
I get it. It's a steep price.
It's an astronomical premium, 29 times EBITDA in this current macroeconomic rate environment. For a company that makes cooling tubes, you have to convince me they didn't just get caught up in the AI hype cycle and severely overpay out of FOMO.
It is a phenomenal question.
Because every company wants an AI strategy right now. How is a $4.75 billion price tag for a hardware cooling company actually justified?
To answer that, we have to look at the total addressable market, the TAM, and the inescapable physics of modern computing.
Okay, walk me through it.
First, let's look at the market expansion. Before buying CoolIT, Ecolab's footprint in the global high-tech sector had an addressable market of roughly $5 billion. Acquiring CoolIT instantly doubles that TAM to $10 billion.
Just overnight, doubled.
Overnight. But more importantly, you have to understand the thermodynamics of what is happening inside these data centers.
Yeah.
Why is liquid cooling suddenly worth a 29x multiple? Let's trace the history for a second.
Yeah, set the stage.
For decades, a data center was basically filled with standard CPU servers. To keep them from overheating, you used standard air cooling. You pumped freezing cold air through the raised floor tiles into what are called cold aisles.
Right. The servers sucked the air in, blew the hot air out the back, and massive HVAC units chilled the air again.
Exactly. It was basically a giant, heavy-duty air conditioning system.
And that worked perfectly fine for traditional cloud computing, running emails and hosting websites. But the physics completely break down when you introduce AI.
They absolutely shatter. The new generation of AI hardware, the NVIDIA Blackwell chips, the advanced AMD accelerators, they're fundamentally different beasts. They are packed with billions more transistors. They're operating at such an incredibly dense compute level that they run astonishingly hot.
Like, how hot are we talking compared to the old stuff?
Well, the thermal design power of these racks has gone from maybe 10 or 15 kilowatts per rack historically to 100, 120, even pushing 150 kilowatts per rack today.
That is an insane jump.
It is. And air simply lacks the thermal capacity to carry that volume of heat away fast enough. It honestly doesn't matter how large your fans are or how cold the air is simply not a dense enough medium.
So what happens if you try to use air?
If you rely on air, those multi-million-dollar AI chips will literally throttle their performance to save themselves, or worse, they will just melt. So liquid cooling is no longer a luxury efficiency upgrade. For next-generation AI, it is a mandatory physical requirement.
And the power statistics in the M&A presentation illustrate this perfectly. This is the bottleneck I mentioned at the very beginning of the deep dive. Power availability is the single biggest constraint on global AI growth right now.
You literally cannot build power plants fast enough to feed these data centers.
Exactly. In a traditional air-cooled data center, the mechanical cooling systems, the chillers, the fans, the pumps, can consume up to 50% of the entire facility's power envelope. Think about how incredibly wasteful that is.
Half the power goes just to cooling.
Half of the electricity drawn from the grid isn't doing any actual computing. It is just blowing cold air around a room.
It is entirely unsustainable. Now let's contrast that with CoolIT's direct-to-chip liquid cooling technology. Water, or specialized cooling fluid, has a heat capacity vastly superior to air.
By orders of magnitude.
Right. So by running this fluid through microscopic channels, directly on top of the silicon chip itself, you capture the heat right at the source. Because liquid is so efficient, the energy required to run this cooling infrastructure drops from 50% of the facility's power down to closer to 10%.
And that is the crucial metric. If you free up 40% of your data center's power envelope by ripping out the giant air conditioners and installing closed-loop liquid cooling, you do not just save money on your electric bill.
No, it's way bigger than that.
You can suddenly install 40% more AI chips in the exact same building without having to petition the local municipality for a new electrical substation. You are unlocking stranded power capacity.
You are exactly right. And the efficiency gains extend beyond just electricity. They extend to the water itself, which is becoming a massive geopolitical issue.
Oh, absolutely. One of the most striking details highlighted in the M&A deck is the car wash metric.
I was just going to bring that up.
Yeah, explain the car wash metric because it really visualizes the impact here.
So traditional data centers consume millions of gallons of water, evaporating it continuously through giant exterior cooling towers to reject the heat. It is a severe strain on local municipal water supplies.
And tech giants like Microsoft, Google, and Amazon are facing intense community pushback for draining local reservoirs.
Right. But CoolIT system changes the equation completely. It is a closed loop. The specialized fluid captures the heat at the processor, flows to a heat exchanger where the heat is transferred out, cools down, and loops right back to the processor.
So nothing is evaporating.
Exactly. Because it is a highly engineered, closed-loop architecture, the presentation notes that it shrinks a massive data center's net water footprint down to the equivalent volume of a local neighborhood car wash.
The car wash.
Yeah.
That completely eliminates the environmental friction for the hyperscalers trying to build new facilities.
So returning to my skepticism about the $4.75 billion price tag, I'm starting to see the math here. But what is the actual runway for growth? Like, are they buying at the top of the curve?
Not even close to the top. They're buying at the absolute baseline. Really?
Yes. During the Baird Industrial Conference, CEO Christophe Beck pointed out a growth indicator that completely contextualizes that valuation multiple. As of today, only 5% of existing data centers utilize liquid cooling infrastructure.
Just 5%.
Just 5%. That leaves a 95% unpenetrated market. As AI workloads become the baseline standard for the entire tech industry, those legacy air-cooled facilities will be physically incapable of running the necessary hardware.
So they will have to upgrade.
They will be forced into an unprecedented retrofit cycle. Yeah. The liquid cooling market is projected to reach $50 billion by 2035, compounding at a 30% annual growth rate.
Wow.
So Ecolab isn't just acquiring a product line. They are securing a dominant choke point in an infrastructure upgrade supercycle that the entire global economy relies upon.
Okay, that makes the 29x EBITDA multiple sound a lot less like a reckless gamble and a lot more like a calculated toll booth.
A very lucrative toll booth.
But the CoolIT acquisition doesn't exist in a vacuum. I mean, it is not just an isolated piece of hardware they bought to slap an Ecolab logo on. The true genius of this strategy is how CoolIT plugs into Ecolab's broader, already established infrastructure.
This is where the synergy really pops.
Yes. The sources outline a deeply integrated, three-tiered ecosystem strategy. It creates an end-to-end moat that I honestly don't think any other company on Earth can currently replicate.
I would agree with that.
Let's break down this cooling-as-a-service site-to-chip ecosystem because it touches every single level of the AI supply chain.
It is a brilliant, vertically integrated strategy. So let's start at level 1, which is the fabs.
The chip factories.
Right. These are the semiconductor manufacturing facilities,
Yeah.
the multi-billion-dollar factories in Taiwan, Arizona, and Europe, where the silicon wafers are actually etched.
Right.
Now, to manufacture an advanced AI microchip, you need water that is astonishingly pure.
Like, how pure?
We're talking about removing impurities down to the part per trillion level. Think about that level of measurement. A part per trillion is the equivalent of a single drop of water diluted into 20 Olympic-sized swimming pools.
That is almost unfathomable.
It is. And through their prior acquisition of a specialized company called Ovivo, Ecolab provides the most advanced technology in the world to recycle and purify water at this ultra-pure level.
So this isn't just a nice to have for the factory.
No, this is not a luxury for a fab. It is a hard physical necessity. If there is a microscopic trace mineral in the water used to wash the wafer, the entire batch of chips is completely ruined. The quality of Ecolab's ultra-pure water directly dictates the manufacturing yield of the fab.
So they are essential at the very birth of the chip itself. Then you move down the chain to level 2, which is the power plants. We just established that AI requires an unprecedented surge in baseload electricity.
Data centers are acting like giant industrial sinks for the power grid.
Right, so Ecolab operates at the power generation level 2. They utilize their proprietary connected water technology, known as 3D TRACER, to manage, treat, and optimize the enormous volumes of water required to run the cooling towers at the actual power plants fueling the grid.
I am so glad you brought up 3D TRACER, because we really need to explain the mechanics of what that actually is.
Please do, because it sounds like sci-fi.
It kind of is.
Yeah.
When water is heated and cooled in industrial volumes, the dissolved minerals within it, like calcium carbonate, they want to precipitate out and form hard scale on the inside of the pipes.
Just like the scale on a home shower head, but on an industrial level?
Exactly. And if a thin layer of scale forms on a heat exchanger in a power plant, it acts as an insulator. So the plant has to burn significantly more fuel to generate the exact same amount of electricity.
Which kills their efficiency.
Right. So 3D TRACER uses optical sensors fluorometers that detect proprietary fluorescent tracing molecules mixed into Ecolab's chemical treatments. It reads the chemical composition of the water in real time, continuously.
So it's constantly watching the water chemistry.
Constantly. And if it detects that scale is beginning to form, it automatically injects precisely the right amount of polymer chemistry to keep those minerals suspended in the water, preventing them from ever sticking to the pipes.
That is incredible. So by doing this at the power plant tier, Ecolab ensures the foundational electricity supply for the data centers remains reliable and hyper-efficient.
Exactly. They protect the grid.
And that brings us finally to level 3, which is the data center itself, right down to the direct-to-chip cooling. This is where CoolIT completes the puzzle.
The final mile of the cooling journey.
Right. At the facility level, you have CoolIT's physical hardware. You have the coolant distribution units, or CDUs, which are the sophisticated pumping stations managing the flow and temperature of the fluid.
The big metal boxes, basically.
Yeah. And then you have the rack manifolds acting as the arteries, distributing the fluid into the specific server racks. And finally, you have the cold plates, the finely engineered pieces of metal containing microscopic channels that sit directly on top of the silicon processor.
Capturing the heat through direct thermal conduction and whisking it away into the liquid loop.
Exactly. So when you look at all 3 tiers together, the scope is just staggering. I mean, Ecolab is deeply involved. From the moment the raw silicon is washed at the fab, to optimizing the power plant, generating the electricity to run it, all the way down to the millimeter of space above the chip, physically keeping it from catching fire.
They are everywhere in the chain.
The best analogy I can think of to illustrate this system is the human body. Think of artificial intelligence as this rapidly evolving, incredibly powerful new organism.
Okay, I like this.
At level 1, Ovivo at the fabs acts like the liver and kidneys. It is purifying the blood, ensuring that the fundamental building blocks, the chips themselves, are flawless and free of toxins.
Right.
At level 2, the 3D TRACER systems at the power plants are ensuring the heart keeps pumping, providing the immense energy and blood flow required to sustain the organism.
Pushing the electricity through the grid?
Exactly. And then at level 3, you have CoolIT. CoolIT is the sweat mechanism. It is the circulatory system reaching right into the brain of the organism, the AI chips, and keeping it from overheating and shutting down while it is performing intense cognitive work.
That's a really vivid way to look at it.
Because without all 3 biological systems working in perfect harmony, the organism dies. Ecolab effectively owns the entire fluid life support system for AI.
What's fascinating here is how you connect that biological hardware to a central nervous system. Because the circulatory system is entirely useless if there isn't a brain monitoring it, adjusting the flow rates, and making sure the underlying chemistry is perfectly balanced.
Right, which transitions us into a crucial part of the analysis. Ecolab's digital transformation. Because hardware, even incredibly engineered hardware like a CoolIT cold plate, is ultimately just metal, pumps, and hoses without digital intelligence driving it.
Exactly. Ecolab's digital segment is the secret sauce that binds the entire cooling-as-a-service model together.
And the numbers back that up completely. If we look at the growth engines versus the margin leaders in the Q1 2026 earnings report, the Ecolab digital segment is compounding at an extraordinary rate. It grew by 24%, reaching $99 million in just a single quarter.
That is explosive growth.
It is. And this growth is driven by their proprietary software platforms, primarily something called Water Navigator IQ.
Let's translate what Water Navigator IQ actually does for a customer. It is an AI-driven software platform, but doesn't just give you a dashboard showing how many gallons of water you used yesterday.
Because that kind of historical data is largely useless for immediate optimization, right?
Exactly. Knowing you wasted water yesterday doesn't help you today. Instead, Water Navigator IQ connects real-time water usage directly to business outcomes. Ecolab calls this EROI, or Environmental Return on Investment.
Okay, how does that work in practice?
It takes the sensor data and translates it into financial and operational risk. It can ping a plant manager's phone and say, hey, your water flow rate in Sector 4 has increased by 2% over the last hour. Based on historical models, this indicates a failing valve.
It catches it before it breaks.
Right. And it tells them, this inefficiency is currently costing you $400 an hour, and if the valve fails completely, it will result in $20,000 of lost manufacturing revenue.
Wow. So it isn't just tracking water, it is actively protecting the customer's revenue stream.
Exactly. And the true competitive advantage crystallizes when you combine that predictive digital intelligence with the new hardware they just acquired. Think about the synergy of embedding Ecolab's 3D TraceR sensor technology directly inside CoolIT's coolant distribution units in a data center.
Oh, that is the integration of the decade.
It really is. The CDU is pumping specialized liquid through racks containing $100 million worth of sensitive AI hardware. If that liquid degrades, if the pH balance drifts, if a microscopic bacteria manages to grow in the fluid, it could foul the tiny microchannels inside the cold plates.
And if those channels clog?
The chip overheats and destroys itself instantly. Millions of dollars gone.
So by putting 3D TraceR inside the CDU, Ecolab achieves real-time microscopic visibility into the cooling quality.
Precisely. The system provides predictive maintenance. The sensors can detect minute changes in pump pressure and alert the facility operator that a component is showing signs of wear weeks before it actually breaks and causes catastrophic downtime.
Furthermore, it enables automated precision dosing, right? Like we talked about at the power plants.
Yes. If the chemistry of the coolant starts to drift even slightly out of spec, the TraceR system automatically injects the exact microscopic amount of chemical biocide or pH balancer needed to correct it, instantaneously, without a human engineer ever having to touch a valve.
I want to highlight something from the sources that proves Ecolab isn't just dreaming this up. They are already executing this level of digital scale. Just look at the global pest elimination segment we mentioned earlier.
Well, this is a great comparison.
It sounds entirely unrelated to data centers, right? But the underlying technology architecture is exactly the same. They have already deployed millions of smart, connected devices globally.
The IoT rodent traps.
Yes. We're talking about IoT-enabled rodent traps in commercial warehouses that use complex algorithms to detect pest activity, automatically alert technicians, and predict infestations before they spread. The 10K notes they are targeting 1 million fully connected smart devices by year-end 2026.
Which proves definitively that Ecolab possesses the enterprise-grade IT infrastructure to manage massive, secure, reliable IoT networks globally.
Exactly.
If we connect this to the bigger picture, when you combine that proven digital visibility with the CoolIT hardware, it continuously and irrefutably proves the total value delivered.
Because the customer sees the data every day.
Right. The data center operator logs into their Water Navigator IQ dashboard and sees exactly how much electrical power they saved that day, how perfectly the thermal limits of their Blackwell chips were maintained, and how much potential downtime was avoided through predictive maintenance.
It continuously justifies the customer's subscription to the cooling as a service model. It creates the ultimate lock-in, where the software and the hardware are indistinguishable from one another.
They become one essential service.
The vision is flawless. The strategy of locking in the data centers with hardware and software is brilliant. But let's take a collective breath here and shift the tone.
Let's do it.
Because I am playing the role of the critical investor today, and we need to talk about the harsh realities of the real world. It is incredibly easy to sit here and get starry-eyed about AI, liquid cooling, and 30% growth rates.
It's very easy to get swept up in the narrative.
Right. But at its core, Ecolab is still a heavy industrial, global corporation, navigating supply chains, raw material costs, and severe inflation. And if you read past the AI headlines in the Q1 2026 materials, the macroeconomic weather was not sunny.
Far from it. The earnings materials detail significant commodity headwinds. Ecolab faced a high single-digit rise in their baseline commodity costs. We're talking about an approximately 9% spike in the cost of the raw chemical precursors and energy they require to manufacture their proprietary formula.
A 9% spike is painful.
Very painful. Geopolitical instability, supply chain bottlenecks, and energy market volatility hit their cost of goods sold very hard. So to combat this margin compression, management implemented a global energy surcharge on their customers across the board, effective April 1st, 2026.
Okay, stop right there. I need to challenge this because a 9% spike in costs is brutal. Anyone can slap a surcharge on a contract, right? Any CEO can send an email saying, hey, due to inflation, we are raising your prices by 9%.
Sending the emails is easy, keeping the customers hard.
Exactly. The real question is, can you raise prices without your customers revolting and leaving for a competitor? This is the ultimate test of pricing power. I mean, imagine I am a hospital administrator. I get a notice from Ecolab that my sanitization and water treatment bill is jumping up due to a quote-unquote temporary energy surcharge.
You'd be furious.
I'll be furious. Why don't I just pick up the phone, call a discount generic chemical supplier and say, hey, Ecolab is gouging me. Give me your cheapest price per gallon and I'll sign with you today.
It is the absolute most important question an analyst can ask about this company. And to answer it, we have to look at how CEO Christophe Beck addressed this during the Baird Industrial Conference. His transparency was honestly remarkable.
What did he say?
He said, and I am quoting the transcript directly here, and as you know, ultimately all the surcharge is going to be converted into structural as well as quickly as we can.
Wow. Let's translate that corporate phrasing.
Yeah. He is openly stating that this temporary energy surcharge they implemented to cover an inflation spike, they have zero intention of removing it when energy prices stabilize.
They're going to convert it into permanent structural margin.
Exactly. They are baking that higher price permanently into the baseline contracts of their customers. Most companies attempting that would face a mass exodus of clients.
Exactly. That takes incredible corporate audacity. How are they getting away with it without losing your market share?
They get away with it because of everything we discussed in Section 1. It all routes back to total value delivered and that 75-25 split.
Right, the savings ratio.
Customers do not leave because Ecolab's digital tools actively prove that the operational savings they generate still far exceed the pain of the price increase. Let's revisit our hypothetical beverage plant.
The one saving $1 million.
Yes, Ecolab was saving them $1 million and taking $250,000 as a fee. Suddenly, Ecolab raises their fee due to the surcharge. Maybe the fee is now $300,000? The 75-25 split temporarily skews to a 70-30 split.
So the plant manager is annoyed, certainly.
Very annoyed. But if they hang up the phone and switch to the discount generic supplier, what happens? They lose the 3D TraceR sensors, they lose the predictive maintenance.
And then their boilers scale up, their energy efficiency drops by 15%, and suddenly their operational costs increase by $500,000.
Precisely. It is a trap, but a mutually beneficial trap. Even with the permanent price hike, the customer's overall profit and loss statement is still far better off sticking with Ecolab than trying to manage the chemistry themselves.
Because Ecolab is saving them vastly more money than they are charging them, the business is incredibly resilient to inflation. They can pass the macroeconomic pain directly through to the customer, and the customer ultimately accepts it because the alternative is mathematically worse.
It is the definition of an impenetrable economic moat. And you can see the results of this pricing power in their margin profile. The institutional and specialty segment, the legacy business cleaning the hotels and hospitals, remains the absolute margin leader for the entire company.
Operating at, what, a 23% margin?
A staggering 23.0% margin, yes. They're using the pricing power in their legacy businesses to fund the massive growth engines in the high-tech and digital segments.
And they desperately need every single ounce of that cash flow and pricing power right now. Because writing a $4.75 billion check for CoolIT is not a trivial event.
No, it's a massive capital outlay.
It is time to leave the theoretical world of AI thermodynamics and enter the financial war room. I want to look at the hard accounting realities and the deleveraging roadmap that management laid out.
Which Wall Street is watching very closely.
Intensely closely. Wall Street is notoriously impatient, and they are intensely focused on the short-term earnings impact of this deal. So let's establish the baseline first. How is the core business performing without the CoolIT acquisition factored in?
The baseline is exceptionally strong. In Q1 2026, despite those severe commodity headwinds we just discussed, the core business delivered an adjusted earnings per share, or EPS, of $1.70.
Which represents a 13% year-over-year increase, right?
Yes, a 13% increase. Furthermore, their full-year 2026 guidance, completely excluding any impact from CoolIT, is projected at $8.43 to $8.63 per share.
So the underlying engine is tracking perfectly toward their long-term stated goal of 12 to 15% adjusted EPS compounding growth.
The core engine is humming beautifully. But then, as management noted in the M&A call, you drop a $4.75 billion annual onto the balance sheet.
And that causes some immediate localized pain.
Let's translate the financial jargon from the sources here. Management had to brace analysts for quote-unquote earnings dilution in the back half of the year.
Explain what that means for the listener.
When you buy a company for nearly $5 billion in cash, you usually have to take on significant transaction debt to finance it. The interest payments on that new debt, combined with the non-cash amortization costs associated with acquiring CoolIT's intangible assets, things like patents, brand value, and customer lists, are going to take a direct bite out of their reported earnings.
And how big is that bite?
The sources project a 20-cent per quarter EPS hit in the second half of 2026.
So a 40-cent total drag on the back half of the year.
Correct. And whenever Wall Street hears the word dilution, even for a highly strategic acquisition, the algorithms tend to panic and sell off the stock.
Recognizing this, management immediately deployed a very aggressive, transparent, deleveraging roadmap to calm the institutional investors, didn't they?
They did. They acknowledged the debt trajectory is steep initially. At the projected closing of the deal in the third quarter of 2026, their pro forma net debt to adjusted EBITDA ratio will peak at 3 times.
Okay, let's define that metric for our listeners who don't spend their days building financial models. Net debt to adjusted EBITDA is essentially a measure of how many years it would take a company to pay back all its debt if net debt and operational cash flow remained completely constant.
Exactly.
So a ratio of 3 times means it would take 3 years of their current earnings to wipe out the debt. Now, for a conservative, incredibly disciplined company like Ecolab that prides itself on a pristine balance sheet, 3 times leverage is uncomfortably high.
It is definitely higher than their historical comfort zone, yes. However, because of the predictable, recurring nature of their cash flows, that subscription-like model we keep returning to management is highly confident in their ability to pay it down rapidly.
What's the timeline they committed to?
They have publicly committed to aggressively paying down the transaction debt and returning to their historical conservative 2 times leverage ratio within just 24 months after the deal closes.
So it is a highly managed, disciplined period of financial digestion.
Very managed.
But the absolute most brilliant part of this entire financial strategy, the detail in the sources that proves the timing of this acquisition was just an absolute masterstroke by the CFO, is how they manage the path to accretion in 2027 and 2028.
Oh, the amortization roll-off. This is fantastic.
We need to talk about this amortization roll-off because this is an accounting reality that almost feels like magic.
Yeah.
We established that in late 2026, there is a 20-cent quarterly drag on earnings due to the financing and the amortization of CoolIT's assets.
Right.
But the projections show that in 2027, that negative impact is effectively neutralized. It just vanishes. How is that mathematically possible if they still own the assets?
It is a phenomenal piece of strategic financial planning. To understand it, I need to explain how amortization works, using a simple analogy. Think of amortizing an intangible asset, like paying off a 15-year mortgage on a house.
Okay, so every month you take a scheduled charge against your income to pay for it.
Exactly. Now let's look at Ecolab's history. Over a decade ago, Ecolab made another transformational multi-billion-dollar acquisition. They bought a water treatment giant called Nalco.
Okay, I see where this is going.
Right. For the past decade, Ecolab has been paying the quote-unquote mortgage, taking regular amortization charges against their earnings for the Nalco deal.
Wait, so they are basically swapping out an old mortgage for a new one.
Exactly. The schedule was perfectly timed. The historical amortization charges from the decade-old Nalco acquisition finally reach the end of their schedule and expire. They roll off the income statement in 2027.
So the old accounting expense vanishes, creating a perfect blank space on the ledger right at the exact moment the new amortization expenses from the CoolIT acquisition begin.
It is a perfect dollar-for-dollar swap on the income statement. Because of that brilliant timing, the The New Deal is neutralized in 2027 and becomes fully accretive, meaning it actively adds to the earnings per share rather than subtracting from it by 2028.
That is incredible. It transitions from a financial drag to neutral to a massive growth engine in less than 2 years, ultimately adding a full point of organic sales growth to the entire global enterprise.
It's masterful execution.
So what does this all mean? I mean, we have covered fluid dynamics, structural pricing, biological analogies, and accounting magic. Let's pull all of these threads together into a final synthesis. What is the ultimate verdict on Ecolab's strategy?
The verdict is that we are witnessing the birth of the ultimate AI utility play. Over the course of a century, Ecolab has executed one of the most successful corporate evolutions in history.
From dish soap to data centers.
Exactly. They transitioned from a company known for selling dish soap to restaurants into an outcome-based efficiency auditor, and now into a high-growth, mission-critical infrastructure provider for the digital age.
They took their undisputed mastery of fluid dynamics, their proprietary chemistry, and their vast network of digital sensors, and they scaled it perfectly to meet the most demanding, power-hungry technological revolution in human history.
And financial analysts absolutely recognize this. The sources note that JP Morgan maintains an overweight rating on the stock, completely validating management's long-term target of 12 to 15% adjusted EPS growth,
The high-tech and digital segments are compounding at double-digit rates.
effectively pulling the entire company's margin profile upward, marching steadily toward their structural goal of a 20% operating margin. They are actively defining what operational excellence looks like for 3 million distinct locations worldwide.
And here is why this matters to you, the listener. You are constantly bombarded with information about the future of tech. Whenever you open your phone and read a breathless, hype-filled headline about the latest NVIDIA AI chip breakthrough,
Or you see a local news report complaining about a massive new Amazon data center straining your city's power grid.
exactly. Whenever you see that, I want you to shift your perspective. Do not just look at the glowing silicon. Do not just look at the software algorithms. You need to be thinking about the hidden, highly engineered liquid infrastructure that is making that computation physically possible in the real world.
Ecolab's the ultimate lesson in looking past the obvious surface-level tech plays.
Because in a gold rush, everyone is stampeding to buy the gold, right? They are buying the AI software companies and the chip designers. But Ecolab is standing quietly at the entrance to the mine, selling the indispensable picks and shovels.
You cannot mine the gold without the shovel.
And you physically cannot run artificial intelligence without the ultra-pure water, the scale-free power plants, and the direct-to-chip liquid coolant. Ecolab has successfully positioned themselves as the absolute bottleneck utility for the entire future of global computing.
And that leads directly into a very provocative thought to leave you with, something that builds on every single mechanism we've unpacked today.
Yeah.
We know that the AI market is currently utterly dominated by the hyperscalers, the titans like Amazon, Microsoft, and Google, and the chip manufacturers like NVIDIA.
Right. They hold all the perceived power in the market right now.
But let's project this reality 10 years forward. If high-density liquid cooling becomes the absolute mandatory standard for all future computing,
Which we know it will.
exactly. And if clean municipal water and available electrical power become the ultimate hard physical limits for global AI expansion, does a company like Ecolab eventually hold more structural leverage over the hyperscalers than the chip manufacturers do?
Oh, that is a fascinating question.
Because NVIDIA can design the fastest, most advanced processor in human history, but if Ecolab cannot provide the end-to-end fluid management to keep it cool, and if they cannot source and purify the water to run the power plant feeding the grid, that multi-million-dollar chip is just a very expensive, very hot paperweight.
It changes the entire dynamic of the technology industry.
It really does.
That is exactly the kind of paradigm-shifting question we love to end on. It forces you to reevaluate who truly holds the keys to the future. A profound thank you to everyone for pulling up a chair and diving into the deep end with us today. Keep looking past the surface. Keep asking the hard questions about how things actually work. And remember, risk defined, portfolio protected.